Welcome to Strategic Wealth Builder. My name is David Edwards, and we're here to help you build a solid financial foundation for your future. Today, I'm here with Scott Christensen, founder and CEO of StrategicWealthBuilder.com. And in this video, we're going to talk about cash value and permanent life insurance policies, specifically whole life insurance policies. So, Scott, can you tell me real quickly, what is it that makes whole life policies so special?
Thanks, David. It's good to be with you today. The whole life is a very, very special financial instrument. In particular, what makes it so valuable is the guarantees that come with a whole life policy. You know, with other types of insurance, there are not always guarantees. With whole life, you have guarantees in the premium, the death benefit is guaranteed, and it has something called cash value, and cash values are guaranteed.
Okay, great. And so what should our listeners know about cash values? What is it specifically? You mentioned the guarantee, but what else is it about cash values that's so important to understand?
Well, cash value is the money that accumulates inside of a whole life policy as you pay the premium. So part of your money goes to pay for the insurance costs or the death benefit. The rest of it goes into what is called a cash value account. So simply put, cash values are a savings account with a life insurance company, but they have many additional benefits over and above just a regular savings account.
Okay, so you're mentioning additional benefits. Like, give me an example of a couple of those.
Well, so first off, there are a number of misconceptions about whole life and how it works. And one of those misconceptions is that you can't get at the cash value inside the policy very easily. That's one myth. It's very accessible. Mm-hmm. But the other thing is the cash values inside of whole life policies don't grow very fast. Some people say, well, it's not a good investment. Well, it was never designed to be an investment. What it was designed to do is create a pool of capital, pool of money that you could have access to over your lifetime for various purposes. And so in the old concept of whole life was you put your money into the policy, it developed some cash value, and you just left it there and you never did anything with it. Today's modern policies can be designed in such a way that they accumulate cash much, much faster. And they should be used much differently than the old types of whole life policies that were written even 20 or 30 years ago, but certainly earlier than that. Those policies were never designed to what today's policies can do.
Okay. And so you mentioned it's about how you structure the policy itself, I guess, when you're setting it up, right? So if I hear you correctly, not all whole life policies are created equal.
No, they're not. And a lot depends upon how you design the plan. There were some tax laws that created that changed a lot of things back in the 80s. Okay. And with those changes in tax laws, it now became possible to create and design a policy that had very unique characteristics in comparison to policies from before. And the tax advantages that are now available inside of these insurance contracts, they've always kind of been there, but they've never been utilized as effectively as and efficiently as they can be today.
Okay, so can you explain a little bit more about like these tax advantages that you're talking about in the whole life policy?
Yeah, over the last 40 years, we have shifted from planning for our retirement from a pension-based process to a 401k. And by that, the contrast is that with the pension, the company that you work for, they put the money away, they managed it, and then they guaranteed the payout to you. So you didn't really have much to worry about or not a lot of concern because everything was done for you and it was guaranteed. 40 years ago when 401ks were first developed, the idea was that the corporate America wanted to shift the responsibility for your retirement from them to you. And by doing so, they utilized the 401k, which had some tax regulations applied to it. And so one of the first problems that is created with 401ks is that you're putting money in pre-tax, okay? You're putting in money, not having to pay tax on it. The money does grow tax deferred, meaning there's no taxes that accumulates, but on the withdrawal side, you must pay tax. None of the money inside of a 401k or an IRA has ever been taxed. And so the tax becomes due in the future. So you're deferring the tax, but you're also deferring the tax calculation. And when we ask people, do you think taxes in the future are going to be higher or lower? The standard response is almost always they're going to be higher. Well, if they're going to be higher, why would you want to defer your retirement dollars into a future where you have no idea what the tax bracket is that you're going to be in at that point in time? So that's just one thing we point out to people. Now, there's another feature that we talk to people about, and that is the idea that in your 401k, those are generally market-based returns, meaning the underlying investment in your 401k is a mutual fund, and mutual funds can go up or they can go down. And unfortunately, as we've seen over the last couple of decades, there's been some real significant downturns. And when those things happen, one day you've got 2 or 3 or 400,000 or more in your 401k, and the next day you've got 20 or 30% less. And when I said the next day, over a period of time, the market falls, and that may have a significant impact as to when you can retire. So that is something that is a problem with 401ks. Now, we're not telling people not to put money in 401ks. We're asking them to understand how they actually work. So in contrast with a whole life policy, one of the great features is that whole life policies, the cash value, not only is it guaranteed, in other words, if the market goes down, you can't lose money, it's guaranteed to increase every single year. Every year that you pay that premium, it is guaranteed to increase in value. And so that it's just not subject to market risk. So it's another place to store capital for current and future needs that may become extremely valuable to you in the future. All right.
So you mentioned a couple of the problems so far with the 401ks and IRAs. Is there more that people should really know about cash values and how they work in these policies?
Yeah, we use an acronym, LUC. So Lucy or Lucky, however you want to put it. It stands for liquidity, use, control, certainty, and enjoyment.
Those all sound like good things.
Well, they are. And so let me go into a little more detail as to, so having liquidity, let's talk about your 401k, for example. Is the money really liquid? And the answer is there is some liquidity, but not significant liquidity. For example, if you want to pull money out of a 401k and not put it back in, you have to pay taxes on that withdrawal. If you're younger than 59 and a half, you're going to have to pay a 10% penalty. So there's a reason that penalty is there and the tax is there, so that people don't just put the money in and take it out, because it is for their retirement. But that means that the money is stagnant. The only thing that could happen to it is market ups or market downs. And if you had an emergency or a financial opportunity or something that you needed to do where you needed access to the money, the only way you can get money out of your 401k is to borrow it. Now, that's not necessarily a bad thing, because the government, they require you to put the money back, or they'll tax you and penalize you. They'll also require you to put the money back over a specified period of time, which they set, at an interest rate that they set. So in contrast, money inside of a whole life insurance policy has none of those restrictions, none of that red tape, no taxation, no penalties. You are free to use the money whenever you want to use it. So you have liquidity, you have use, you have control. And by control, we mean it's not subject to market risk. Therefore, if we look back in previous years where the market turned down, let's say someone was getting ready to retire in 2000 or in 2008 or in 2022. These are all years that we had big down years. They lost significant amounts of their portfolio, and most people had to postpone their retirement plans because of that issue. With whole life, we don't have that issue. You don't have to worry about the market going down.
Okay. Yeah. So it sounds like there's, again, the liquidity, use, control, and enjoyment of that money. And the fact that you said a couple key things there that I picked up on, which is like you have control over it versus somebody else setting the guidelines, i.e. the government. You get to set the rate that you're borrowing the money back from. Is that correct? And like you mentioned, like there's no red tape. I don't have to qualify for the loans. Talk to me a little bit more about that.
Yeah. So you don't actually get to set the rate, but there's some fluctuations in that process. For example, we teach our clients a process we call the family banking systems.
Okay.
And really all that is helping people understand how financial institutions work, how they make money, and then looking at it from our perspective as the consumer. Is there any way for us to, turn the table, so to speak, on the financial institutions? Can we utilize the financial systems that are available to our advantage. So, for example, let's look at purchasing vehicles. That's something that, generally speaking, most people don't pay cash, at least for the more expensive cars and the newer cars. And so, as a result, you pay cash, you finance that with a local financial institution. Well, the financial institution, they set the interest rate, they set the time period. You may want a longer time period. They may agree to it, but many times they don't. And then they have a fixed payment. That payment must be made every single month, or there's a ding goes on your credit. And sooner or later, if you don't make amends with the financial institution, they're going to come pick up the vehicle. Well, the family banking system is a process of learning how to create and build capital and utilize it by paying cash for things, but then paying yourself back with interest. Now, whole life policies generally have an interest rate, and that interest rate is set by the insurance companies. Generally speaking, that's around 4 to 5%, sometimes a little bit higher. But the interesting thing is that you don't have to make specific regular payments. You can set the term. If you want to pay it back over 24 months, you can do it over 24 months. If you want to do it over 7 years, 84 months, you can do it over that period of time. You set the time frame. You select the payment. And in fact, if you need to take a break and you can't make a payment for a while, you can do that as well. So you have a significant amount of control, and even the interest that you pay the insurance company, ultimately, in a roundabout way, makes it back into your contract to help them fulfill their guaranteed commitments to you. And most whole life policies that we use pay what's called a dividend, which means if the company does a little better than they thought they would, they're going to pay you an additional return over and above the guaranteed cash value increase. So there's so many advantages for people to use these insurance contracts, these whole life policies, to create greater liquidity, use, control. The certainty comes in because the cash values don't go down. They're not market risk. And the other thing is enjoyment. Many of our clients have gone out and purchased things that they are enjoying, like four-wheelers, snowmobiles, boats, houseboats.
I remember, you bought a houseboat.
I bought a houseboat using this very scenario. And so every summer, my family enjoys going to one of the larger lakes here in Utah, and we spend a week there and enjoy. So we create memories on something that we finance through our family banking system.
That's pretty cool. So what are some of the other ways? So you're talking about for loans. Are there other ways that people could use this cash value, this pool of capital that's being built up?
Well, I mean, there's the options are unlimited. I mean, there's so many things. You could pay for college education. You could pay for weddings. You could finance vehicles. There's if you can think of it, if you're going to buy it, if you were going to finance it, here's a better way to finance it. If you were going to pay cash for it, here's a better way to pay cash for it. This is the better place to utilize the funding. And there's a lot of things that people think to be true about money that aren't. And one of the things that we try and do is help people understand some of those financial myths. And we really want to help them use the financial tools that are available. There's a number of chapters in there that talk about things that you probably didn't realize were going to impact you financially going forward. We believe that the economic future is going to be way different than anything we've experienced in the past. And as a result, that requires, where the new financial paradigm is requiring a new way of thinking. So if people want to get my book, they can click on the link below. And we had a link that if they would pay the shipping, we would send the book out for free. But to our listeners that order from after watching this video, we'll send it to them for free. And again, we're designed to give you an idea of some of the things you're going to have to deal with. And then I would suggest that you subscribe to our YouTube channel, that you go to strategicwealthbuilder.com and get registered. We have a whole bunch of content there. That's our educational video library there. We're posting stuff all the time. And if you'd really like some help on moving forward financially, if you feel like you're not making the progress that you'd like to make, take a minute. And there's another link that you can click on and schedule a 30-minute free, no obligation consultation. Well, we can talk with you about where you're at, where you're trying to get to, and things that you might do differently that just might really make a huge difference in your financial life. So we look forward to working with anybody that calls in and schedules that appointment.
All right, great. Well, hey, thanks again. It's always good to talk to you, Scott. And we'll look forward to getting with you next time.
All right. Thanks, David.
Have a great day.
You too. Bye-bye.